In this section, we are going to look at the impact of sales exceeding production on variable and absorption costing. Recall from the two prior videos looking at production and sales at different levels, we use the following cost information. Production cost of $4 per unit for direct materials, $8 per unit for direct labor, $3 per unit for variable overhead, and total fixed overhead production costs of $600,000. Variable selling and admin of $2 per unit sold, plus an additional $200,000 fixed each year. In the prior two videos, we assumed different levels of production and sales. In this episode, we are going to assume that the company produced 60,000 units but sold 80,000 units. This indicates that their production was not enough to meet sales, so they had to dip into the inventory that was left from the prior year's production. When we prepare an income statement under absorption costing, we are going to see that sales of 80,000 units at $40 per unit, total revenues of $3.2 million. Cost of goods sold. Under absorption costing, recall all product costs are absorbed into the cost of goods sold, so all of our variable costs plus our fixed overhead cost. Total product cost under absorption costing of $25 per unit. Times the number of units sold gives us cost of goods sold of $2 million. Leaving us with a gross profit or a gross margin of $1.2 million. We subtract out all selling and admin costs, both fixed as well as variable, 80,000 units at $2 per unit, leaving us with total selling administrative costs of $360,000 and net income of $840,000. Now let's prepare an income statement for the same year under variable costing. Revenues will be the same. Number of units sold at $40 per unit, $3.2 million. Next on a variable costing contribution margin format income statement come the variable costs, both variable production as well as variable selling and administrative. Production costs include only the variable, direct materials, direct labor, and variable overhead costs at $15 per unit. Times the number of units sold. Our variable selling and admin cost, $2 per unit, times 80,000 units sold, leaving us with a contribution margin of $1,840,000. Next, we subtract out all of our fixed costs, fixed overhead, as well as fixed selling and administrative. $800,000 in total, income of $1,040,000. Recall that income under absorption costing was $840,000. But when we prepared the income statement under variable costing, income was $200,000 higher at $1,040,000. Under absorption costing, $200,000 of last year's overhead is expensed because we had to use 20,000 units of ending inventory from last year in order to meet this year's selling needs. That means that the $200,000 of last year's fixed overhead that had been expensed last year under variable costing and was not expensed last year under absorption costing because it was attached to inventory that was in inventory, that $200,000 this year was released into income as an additional expense under absorption costing. Whereas under variable costing, only the current year's fixed overhead costs were recorded as an expense. That meant that absorption costing's net income was lower than variable costing net income. Looking at a summary of the 3 years, notice that in a year when production and sales are equal, income will be the same under both methods. But when production exceeds sales, absorption costing will result in a higher net income because some of the current year's fixed overhead is absorbed into ending inventory. However, when the number of units produced is less than the number of units sold, absorption costing's net income will be lower than variable costing because some of prior year's fixed overhead is released into income calculations, causing more expenses to be recorded and a lower net income. Here is a way to convert variable costing to absorption costing income, and it all has to do with that fixed overhead. If we take variable costing income, and in a year when fixed overhead is deferred in ending inventory, we add $200,000 to variable costing to reflect the amount of overhead that was absorbed into inventory to get us to income under absorption costing. But however, in a year when income includes expenses from prior year, fixed overhead recognized from beginning inventory carried forward, we have to subtract that from our variable costing to get to absorption costing net income.